What are you looking for in the week ahead?
Well, John, thanks for having me on. When you go shopping for diamonds, you have the four C's. Well, we have the four C's as it applies to banks and bank stocks. The first C would be CCAR, or the recent Fed stress test. This will be the first earnings season when we can ask the banks about that stress test, when they expect to resume buybacks, and what other actions that they'll take. Remember, even with all the cuts, a 1/4 decline in residential real estate, a 1/3 decline in commercial real estate, a 1/2 decline in the stock market, that's all through the Fed stress test. Even with that, the bank balance sheets are strong. So we still call this an income statement recession and not a balance sheet recession. The second C would relate to credit and credit losses. And we do think provisions will be higher. And for that reason, we do think this will be earnings hell and worse than the first quarter. But as bad as it should be, this should be as bad as it gets. Now, it might not get a lot better if the COVID crisis remains, longer, but the combination of lower interest rates, the impact to net interest margins and credit losses, this is a tough quarter. We think earnings will be down by 1/2 year over year. The third C is clarity or lack of it. Look, you have seen some reopening. So all else equal, we think things are a little bit better, even if not as much better, with some of the recent increase in the COVID cases. And the fourth C is the cost. And these banks are dirt cheap on an absolute basis and especially on a relative basis to the market as a whole. So you were saying before, are expectations low? Expectations are absolutely low based on these bank stock valuations.
Mike, can you help me out with something? I'm not in your world. I try and get knee deep to some degree, but I'm always a little bit further away than you are. And I'm wondering, for the people that got in touch with their bank several months ago and said, you're not going to take any money out of my account for that loan for the next several months, let's come to an agreement. Have you got any idea how much of those kind of agreements have turned into loan losses over the last several months? Are we going to get some clarity on that in the next several days?
Well, what's interesting here, you should not see dramatic increases in problem loans yet. Banks are working with the borrowers, individuals, businesses, larger corporations, to help bridge the gap from the pre-COVID economy to the post-COVID economy. And some of the support does not run out until another 6 months. So what's interesting, you'll say, oh, what are the problem loans? Well, they're not that bad. What are the actual loan losses? They're not that bad. It's the reserving for the problem loans that will hit the earnings, which is actually a good thing. Banks are getting ahead of the problems more than ever before for any recession in the past 50 years. In fact, we think after this quarter, the reserves for problem loans should equal the level of half the total losses experienced in the global financial crisis. So that's a good thing. So during this recession, banks are part of the solution as opposed to being the problem during the global financial crisis.
So, Mike, this is the really important dimension of this. It's banks getting ahead of things. The banks got ahead of things on a capital return program as well. They suspended buybacks long before the regulator told them to do so. Are you confident they're ahead of things when it comes to the dividend, which has come into question a little bit over the last couple of months?
Well, look, I'm going to say it again because it's so important. I think the stock market is missing this point. This is not a balance sheet recession. So the dividend cuts, you've had several dividend cuts among the 100 largest banks. Typically, it's due to an earnings issue, not a balance sheet issue. It's not because they don't have enough capital. It's because their earnings are less than the dividends they're paying out, or it's a too high of a percentage. So, yeah, there could be dividend cuts, especially at smaller bank. The smaller you go, the more chance there are for dividend cuts. Having said that, for the largest banks, and we do think Goliath is winning, the three largest banks, Citigroup, Bank of America, and JP Morgan, we estimate they could still pay their dividend even if loan losses were 50% higher than they were during the global financial crisis. We've run over 200 earnings models that bear that out. So we think those dividends are safe. And so if you want a lot of safe dividends, you get a nice 4% dividend yield in a low rate environment. You can buy those three along with U.S. Bancorp and PNC.
Mike, we've got the names you're constructive on. Who's vulnerable going into earnings season?
Well, look, we've had sells all year on Comerica and KeyCorp. And you know what's interesting? Both have new CEOs. So these new CEOs have inherited problems. They've inherited energy problems, especially Comerica gets hurt by lower interest rates more than any other large bank. So Comerica will be, that'll be interesting. And as you get smaller, banks size 20 through 100, those smaller banks are more plain vanilla. They don't have the capital markets activity to help offset the pain. By the way, capital markets, you had record, fixed income issuance, trading's good, but the smaller banks don't have that. And they also don't have as many levers. And the other thing is, this is really coming out in spades. Digital banking. This is the age of digital banking.
Yeah.
And leaders in that are, JP Morgan, Bank of America, and Citigroup's actually improving a lot faster than I personally had expected.